2023 is the year in which we're going to see legislation passed, both creating a regulatory regime for non-sovereign crypto, and it's the year in which we're going to see increasingly rapid Federal Reserve efforts to develop a digital dollar.
Good day, everyone. Welcome and thank you for joining today's edition of Teneo Insights. I'm Kevin Kajiwara with Teneo Political Risk Advisory in New York City. Before I introduce our call today and introduce our guest, I want to comment very briefly on the Russia-Ukraine situation that has been developing over the last several months, but accelerated dramatically last night. We will at Teneo be holding a special edition of Teneo Insights call, most likely tomorrow, so please look out for the specifics on the time and how to connect to that. But let me just say that this is, I think, in my view, this is the test. This is the test of the Western alliance system and the post-war order that has prevailed since the end of World War II. This is the most dramatic test of that system. And I would say that Putin's objective here is more ambitious, clearly at this point, than just taking control of the Donbass and some of the other territories. This very large-scale action is aimed at degrading the country's defensive capabilities, and ultimately, he is looking to take control of critical infrastructure and force the swift capitulation of the government. The extent of Moscow's military action, I think, suggests that they are trying to achieve this via shock and awe, in other words, as quickly as possible. And the extent to which they are able to achieve their objectives in the first few days of the attack are going to be indicative, I think, of further developments on the conflict. So one key signpost to watch here is going to be whether Russian forces can take control of the country's large cities like Kyiv and Mariupol, which are well fortified and whose publics have previously expressed a strong intention to show resistance. If the Ukrainian armed forces and the Ukrainian people can withstand the first several days of the conflict, then Russia risks getting dragged into a much more protracted and costly conflict, which would be very difficult to sell as a victory at home. Now, at the same time, the speed and the scope of the Western response is going to be crucial to determining the credibility of the Western alliance, as I suggested. A number of NATO states bordering Russia and Belarus have now triggered NATO Article 4 to discuss further steps to reinforce security of the alliance members. But the thing to watch is going to be the extent to which NATO members agree to provide practical support to Ukraine. On the one hand, limited support would risk undermining, again, the trust in the alliance. On the other hand, excessive NATO support could lead to further aggravation of the conflict with Moscow and increase the risk of a direct confrontation between Russia and NATO powers. The Western allies are now going to be challenged to demonstrate their unity in imposing the full package of severe sanctions on Russia, despite likely considerable losses to their own economies. And the problem of sanctions is sanctions have a better chance of working when you've got near universal implementation of them. Countries like China, countries like Switzerland right now not participating, and we're not going for the jugular. SWIFT is sort of off the table at the moment, as are hydrocarbon imports from Russia and the payment for those imports. So, we're not really putting on the full implementation of potential sanctions. And there's also the question of long-term sustainability of those sanctions. So we'll have more on this with my colleagues tomorrow. So please stand by. So to today's subject, Bitcoin. The chances are some of you own it. The chances are some of you are glad that you don't own it. The chances are some of you wish you owned it. But I'm sure that there are a great number of you who are really more like me. You're sort of crypto curious, if you will. But every time you hear the arguments for all the revolutionary good that cryptocurrencies are going to do, you're still in that sort of yeah, but phase. But here's the thing. The train has left the station, and as so often is the case with financial innovation, particularly one as potentially game-changing as this, political leaders and regulators tend to be behind the curve. So to help us understand this fast-moving phenomenon, my guest today is a renowned blockchain technology advocate, but he's also a former financial regulator. Chris Giancarlo was the 13th chairman of the Commodities Futures Trading Commission, the CFTC. He was made a commissioner by President Obama in 2014, and he was appointed chairman by President Trump in 2017. While at the CFTC, he oversaw the first Bitcoin futures products entering the marketplace. Today, Chris is a senior counsel at the law firm Wilkie Farr, where he's co-chair of the Wilkie Digital Works practice. The American Crypto Association has named him one of the top 10 crypto lawyers. And he's the author of a new book, which you can see right here, CrypotoDad, The Fight for the Future of Money, out from Wiley currently. He's known as CrypotoDad for his celebrated call on Congress to respect a new generation's interest in crypto. So I want to thank him for joining me today, and he appears today thanks to the efforts of my Teneo colleague, Tony Sayek. So Chris, welcome. So let's start. Perhaps you can give us your perspective on where things are. There are thousands of coins and tokens out there. Obviously, Bitcoin is the granddaddy of them all, and everyone's aware of not only the stunning highs, but that it's had, but also the volatility, right? And lay people are probably as likely aware of the crimes, right? From Mt. Gox originally to the couple who were just arrested here in New York a couple of weeks ago with several billion worth of Bitcoin in their wallet. So where are we? You know, where do you think we're headed? And give us your perspective on why, on this new, it's beyond disruptive. Let's call it a revolutionary technology, and then we'll get to the yeah, but elements of this.
So thanks, Kevin, and great to be with you. And I'm joining you today from Washington, D.C., where I'm here for a series of policy meetings. So that this august background here is the Cosmos Club in Washington, where I have the pleasure to stay during my Washington visits. I think what I would say is perhaps the pedestrian view of crypto is that it's some sort of new asset class existing alongside, say, traditional asset classes like gold or commodities or perhaps foreign currency. And it's established itself as a new asset class, and we're now going to come to live with it for all its strengths and all its weaknesses as an investment grade or investable asset class. I think actually, quite frankly, that really underestimates what's going on here. This is nothing less than the internet doing to finance banking and money itself what the internet has done to every other human activity, from retail shopping to transportation to entertainment to communications to information. And it is going to have reverberating impacts on not just commodity-like assets like Bitcoin or currency-like aspects of stablecoins, but it's going to affect central bank money itself. And I want to talk a little bit with you and your audience today. In addition to the other work I do, I'm chairman of the Digital Dollar Project, which has been looking at and working with both government officials and the private sector on accelerating efforts to develop a U.S. digital dollar, which is basically a sovereign cryptocurrency. I've said, and I'll repeat for your audience, within 10 years, every major economy, including the United States, will have a central bank digital currency, will adopt cryptocurrency as their sovereign money. So this is a lot more than just the private sector's exploration of money. Every major central bank in the world is now experimenting. In fact, China has rolled out a digital yuan, which is going to have enormous impacts on the global banking system and sanctions. And as we wake up this morning to war, sadly, once again in Central Europe, the power of sanctions, we may see, this may be the sunset of sanctions power as a tool of foreign policy, because the design of the digital yuan is to move outside of the traditional banking system. And once you move outside the traditional banking system, you move outside of sanctions power. And so we've got a lot to talk about this morning. But the point I want to make is this is much, much bigger. This is going to affect traditional banking in a very big way. And maybe that's a good place to start, Kevin, Maybe a good place to start is why I truly believe, and I saw this. The CFTC is the world's probably most important financial regulator, in some ways much more important than the SEC, which primarily is a regulator of domestic capital markets. But the world feeds itself with agricultural commodities priced in dollars, regulated by the CFTC. The world powers itself with energy commodities priced in the United States, overseen by the CFTC. The world trades in foreign currency, and the world de-risks its interest rate with interest rate derivative products priced in the United States, overseen by the CFTC. So the CFTC has a tremendous global influence. And I had the great honor to serve as chairman, as you noted, and to travel around the world and to really see how the internet, having changed everything we know about how information moves, having changed everything we know about communications, changed everything we know about a retail, is now setting its sights on our financial markets. And so that's the big picture, and then we'll drill down a little bit more as we go this morning.
So let's step back for 1 second here, because as I've looked at a lot of the people, some of whom are Bitcoin remain unknown or what have you, but in many ways the design of cryptocurrencies reflects a very specific policy view, which is that government should frankly have less control over money. And yet, when you think about sovereignty and you think about the role of the state, it's often tied up in its ability to control its monetary policy, its ability to control its financial system to some degree. And that is especially true for the United States for the regulatory reasons that you just mentioned, but also because we've had, up until now, the global reserve currency. It in fact is, it may not in the end wind up being effective at further regulating the moves of Putin, but in the absence of military action, it is the weapon that which we and the other Western powers are yielding. So I guess one of the big messages of your book is that we need to, and I quote, make sure that democratic values, freedom of speech, individual economic privacy, free enterprise, and free capital markets are encoded in the digital future of money. So how do we accomplish that? And what does that actually mean in a practical sense?
So there is a sector of this new emerging crypto world that sees it as an opportunity to operate outside of government control. I'll concede that, but that doesn't flow through. That's not core to the innovation. What's core to the innovation is the notion of using the World Wide Web of computers and algorithms on them to actually bypass central ledger keeping. So the hallmark of our existing financial system is that you have large institutions that basically keep track of who owns what and who's transferring value from one person to the other person. They may be banks, they may be central clearinghouses, they may be central banks, but you have the notion of double entry bookkeeping, recording the ownership of who owns what. In fact, let me actually give a real historical view and then bring it back to the future. From the dawn of civilization until almost 400 or 500 years ago, the notion of fiat value was held in the form of a token. That token may have had intrinsic value, say a silver coin, or cows, or cattle, or other things of value, or it may have been entirely fiat, and then it was just a symbol, a clay tablet. But it was a token, and the process of establishing value transfer was I would give it to you, you would give it to me, and possession indicated ownership. But more than that, the value transfer was confirmed by the two parties to the transaction. I would look at the token and put it in my teeth to confirm it was metal, or hold the dollar bill up to the light and see that it had the right watermark. And so the process of verification was unique to the token. And that system, that notion of tokenized money, has served humanity very well for most of our history on this earth, and we intuitively understand tokens of value. The shortcoming of tokenized money, however, is it's local. It doesn't transport well. Dutch merchants found that their Dutch guilders didn't work in Venice, where the common currency was ducats. And so a new system emerged around the year 1600, where merchants would place their tokens on deposit with a bank in return for a banknote, an indication of credit from that institution. And the institution would keep track of whose Dutch guilders were in their vault in return for their banknotes. And hence the modern banking system was born. 90% of the world's money moves today as credit of financial institutions. And the holders of value are accounts kept by those institutions. Your 401 money is a credit of fidelity and a subcredit of the different holdings you have, but it's not an obligation of a sovereign. And there are no tokens backing it up. Fidelity or Citibank is not holding dollar bills in its vault 100% against that. They are extending credit to you from the institution. That is the system we have today. Money moves around the world as a series of debits and credits between financial institutions. Now, it may be backstopped with insurance, FDIC, other programs in other countries, and the sovereign has a role to play in ensuring it. But ultimately, it's our financial institutions that record who owns what and that recognize liabilities and obligations to humanity. And that's 90% of the financial system. That's how money moves around the world. So what is the Bitcoin breakthrough? The breakthrough is we've got this World Wide Web. It's the web that doesn't break because it has no central intermediary. Wikipedia never goes down. The web never goes down because it's just so distributed. There's no single point of failure. There's enormous redundancy in the system. Why don't we, the breakthrough is let's use that worldwide network of computers, an agreed set of algorithms to basically have bookkeeping without bookkeepers. And that's a huge breakthrough. And that's what is so disruptive about this technology. We don't need correspondent banks in this new technology to move money around the globe when the World Wide Web can confirm who owns what in a nanosecond, 365, 7 days, 24 hours a day. And that was the basic breakthrough in a pseudonym or an anonymous white paper produced by somebody named Satoshi Nakamoto in 2008. And from that, Bitcoin is built. Bitcoin is all about using the World Wide Web to confirm value. But Bitcoin is only one type of cryptocurrency. There are thousands, and they all have different properties and different aspects to them. Some, like stablecoins, are not designed to be outside of the banking system. They actually work, well, they're outside the payment system, but they're actually tied to greater or lesser extent sovereign currency. So there's a link in terms of the correlation in terms of value. Others are sovereign digital currencies. As I mentioned, every central bank in the world is now accelerating efforts, including here in the United States, to actually adopt this notion of direct peer-to-peer payments using distributed ledger technology, this notion of a web-based validation system, bookkeeping without bookkeepers. And so this is truly a transformational breakthrough. And while one may look at Bitcoin and its shortcomings, you mentioned volatility, it's actually not a shortcoming as much it's a design feature. I come out of the commodities world. Whenever you have a fixed supply commodity, if demand goes up or down, only one thing can happen, and that's price movement, because you can't increase the supply. Bitcoin is designed to be you cannot, it has a fixed supply. So it is very sensitive to volatility, but is also very sensitive to inflationary pressures. One of the reasons we've seen Bitcoin's price go up is because central banks around the world have been printing an enormous amount of sovereign currency. And so one would argue the volatility of Bitcoin is not a flaw, it's actually an exact property of a fixed supply commodity. And, volatility in commodities, we're very familiar with. Oil was below zero 24 months ago, and now it's going to be approaching $100. So that's a lot of volatility for a commodity where you can actually adjust supply. Bitcoin, you cannot adjust supply. So that's a few random thoughts there, Kevin, but let's drill down a little bit more.
Yeah, so like, I want to, you talked about stable coins ultimately being backed by, I guess, U.S. Treasuries or some other high quality assets. But if currencies or stable coins become, let's say, a common enough medium of exchange, couldn't then still, going back to the sovereignty kind of issue here, a meaningful portion of the money supply would be beyond Fed control, effectively here. So coin holders, either, all of the individuals aggregated, or more concerningly, oligopolistically held, or, more foreign held than US held, couldn't that create an increase or decrease in the amount of digital currency in circulation and effectively control money supply? Question one. And question two is, and this, well, let's talk about
so
that
let me
first,
take that.
Then we're going to move into the regulatory phase.
So Sir John Cunliffe, the deputy governor of the Bank of England, once said to me, he said, it seems like money's a funny kind of thing. It stays stable for 2 or 3 generations and then goes through a complete revolution. And in his view, and I share this view, money's going through one of those revolutions now. And whenever you go through a revolution, it's complicated. And where it's going to stop is still very much in the debate. I'm here in Washington for policy discussions on stablecoins, on crypto. There's a lot going on. But what I think the audience has to understand is there's no going back to the past. The genie's out of the bottle. The question is, how do we, the adults in the room, shape what the future of money looks like? But the future of money is going to be very different than what we've known. The dollar supremacy, the post-world order that we've known since the end of World War II is going through. We're going through a change in the credit cycle. We're going through a change in the money cycle. China is determined to move outside of the dollar-dominated system with their central bank digital currency, which is going to be part of their Belt and Road Initiative. Whether we like it or not, a good part of the globe that is aligned into their orbit is going to move away from a sanctionable regime into one where there's direct payment through the People's Bank of China in a Chinese central bank digital currency, where we're just not going to have sanctions authority because it's not going to move through the Western-dominated bank system. So it's changing whether we like it, and that's why you read that quote. What I'm doing as head of the Digital Dollar Foundation is saying, okay, the technology evolution is at hand, and there will be changes in what money looks like going forward. But let's make sure that the core value set, the value set that got us here, the fact that money should encompass values of economic liberty, of appropriate privacy for licit transactions, of free markets and open markets and global trade. Let's make sure those values are captured in what a future digital dollar, what stable coins look like. And as a former regulator, to make sure that we have principles-based regulatory structures that make sure that if you are operating a stable coin, that you do it in a transparent way so holders of that stable coin can know what you're backing it with. And whatever you say you're backing with, you're held to account for actually that backing. And so, the focus, I think, should be, we're never going to stop this technological evolution, just like Sears Roebuck wasn't able to stop Amazon and the creation of online commerce, just as, Encyclopedia Britannica yielded to Wikipedia. We're not going to say we like the existing banking system, let's keep it the way it is. It's just not going to hold. The genie's out of the bottle. This distributed ledger technology to use the World Wide Web to validate value is an enormous and has a lot of positive benefits, by the way. We've seen financial institution after financial institution failure, whether it be because of cyber hacking, whether it be because of own internal systems. The notion of having basically a global network of computers, which is virtually unbreakable because of all the redundancy built in, as a validator. And also, it puts power in the hands of the individual to directly transact with another individual. Think about global remittances. Almost $1 billion a year of dollar remittances of expatriates in our country remitting money back to their homeland that are paying between 7 and 17% to move money. They can send a text message in an instant, and yet it still takes 4 to 7 days to send a dollar. I mean, Kevin, as you and I know, if you need to get $10,000 to Paris, it's easier to stuff it in the suitcase than it is it's faster, certainly, and get on a plane than it is to send a wire transfer. And that doesn't make sense when we can send a text message or a video, in a second around the globe. So it's funny in a lot of ways. The bank system and finance and money have been the slowest to respond to the internet, but now it's happening.
So let's move into the regulatory element here, because you, as I mentioned at the top, the name of your book derives from your testimony in front of Congress, and that's how you're known in the community. So before we get to the actual regulation itself and what regulators are being tasked with, where is Congress on this right now? I mean, do they acknowledge everything that you just said, or is there an attempt to rein in, or how do you see the political leadership in this country?
Yeah, the one thing I learned from 5 years in Washington is our political leaders are no different than the random man in the street. There are some that are ahead of the technological curve, and others that are years behind. There's some that are small left forward leaning, and there are some small c conservative, resistant to innovation. And so it's not about political party. It's more just about individual human nature. There are some leaders on Capitol Hill, just as there are some leaders in this administration and in the prior administration, that really see how properly channeled this technology can actually make our financial system faster, with greater velocity of money, greater economic growth, lower cost. But there's others, but with the same time concerns about financial crime, about fraud, manipulation. But there are others who are resistant to the change, and they run across the board. I did a hearing in front of the Senate Banking Committee not too long ago, where we were there to talk about central bank digital currency, and Senator Warren used the conversation to rail against Bitcoin and cryptocurrency. But within her same caucus, Cory Booker, the senator from my home state of New Jersey, just last week was talking about how important this innovation is for minority communities. And so within the same caucus, you've got a widely divergent point of view. Where I think we are in the cycle is this. For the last 10 years, the private sector has pretty much had free reign to innovate in finance and money, and have done some extraordinary things. There's already $3 trillion of valuation between stablecoins and cryptocurrency. I mean, that's no drop in the bucket. That's significant. That's all private sector generated. In the last 18 months, and if I might say, some of it began with an op-ed I did in the Wall Street Journal 2.5 years ago, saying if we can land a man on the moon, we can put the dollar into cyberspace, calling on the Federal Reserve to really up its game and take note of what China is doing and what Europe is doing in terms of developing sovereign cryptocurrency. Well, it's now happening. The Federal Reserve is accelerating its efforts. And at the same time, Congress is floating a whole series of bills and legislation. By one count, there's over 30 pieces of legislation in the House and the Senate looking to bring a regulatory regime to cryptocurrency in the private sector, while the Federal Reserve is working on sovereign digital currency. So official Washington, the gears are now moving, and they're moving with greater acceleration. Because it's an election year, I don't expect any of those bills to get passed this year, but I do see them as, in a sense, attempts by legislatures to gain support within this growing crypto community, which is increasingly spending a significant amount of money in PAC donations and others to make their influence felt. So I expect, based on my conversations this week, that 2022 is the year in which 2023 is the year in which we're going to see legislation passed, both creating a regulatory regime for non-sovereign crypto. And it's the year in which we're going to see increasingly rapid Federal Reserve efforts to develop a digital dollar.
Okay, so that last bit that you just said, let's separate those. Let's put the central bank digital currencies to one side for a second, and maybe look at the regulatory regime for both the sort of fiat digital currencies like Bitcoin and its brethren, and stablecoins on the other hand. So maybe I can preface it by saying maybe not everybody is aware, but ahead of the recent G20 meeting, the Financial Stability Board, the FSB, said, look, I mean, to your point, yeah, there's $3 trillion worth of aggregated crypto value out there. But obviously, which is no drop in the bucket, but that's de minimis in terms of the size of the global economy. So right now, episodes of price volatility have really been contained to the crypto market and not really spilled over to financial markets or the economy as a whole. But that is changing, right? And so their concerns are issues of legality. You talked about who owns what, the pseudonymous sort of borderless nature of all of this, leakage, where risks are not confirmed to the crypto market, liquidity, how do we ensure that, say, stable coins or whatnot have the right reserves, and they're not just changing those reserves, and they have the right quality assets in there, as has been so a hallmark of so many financial crises, leverage, coming into the system. So where do you think we need to really focus the regulatory, priorities in the near future as we head toward 2023, like you're saying?
Okay, so I mentioned at the beginning, the role of the traditional banking system has both been to provide the liabilities. It's the liability of Fidelity to you, it's the liability of Citibank to you for your accounts, but also to validate who owns what. I think the cat's out of the bag in terms of the who owns what bookkeeping. I think this technology is not going away, and I think the FSB, where I had the pleasure to serve during my time, is going to recognize that change. The real question is going to be whether banks continue to play a role in the liabilities, and I think that's very likely to remain, and that's certainly an initiative by a number of the major Wall Street banks right now to consider their role in that part of the global system. I think the issues of the risks of holdings of stable coins is one we're well placed to deal with at the global and at the domestic regulatory level. We've been regulated banks for a long time, and a lot of ways, stable coins are more like what they used to call narrow banks than full service banks. They're not in the business of maturity transformation the way banks are. They're not taking short-term deposits to make long-term loans, right? So they don't have some of the same run risk that traditional banks do. I have little concerns that that the global regulatory system, my former colleagues, will be able to come up with a regulatory system for stable coins that will prevent run risk. It's a question of setting standards for what their holdings are, setting standards for transparency, and setting liability requirements if their holdings don't meet their promises to their token holders. I think we can get that right. Again, we've got a lot of experience at the global level, and certainly the FSB, with its representation of all the world's major central bankers, and the work of the BIS, the Bank for International Settlement, the central bank for central bankers, I think we'll be able to come up with standards that they can recommend to the nation states and that the United States can adopt in our own special way, appropriate for the United States, that will be able to put requirements around stable coins. I think the bigger issue is whether if we develop a digital dollar, whether we take the policy decision to have a digital dollar operate alongside non-sovereign forms of money like stable coins and non-sovereign commodities like Bitcoin, or whether central bankers, as China is doing, will insist that their sovereign digital currency be exclusive. As you know, China has shut down other cryptos not because it's actually afraid of their run risk, because it wants its sovereign currency to exist exclusively for means of its population. So the question is whether the West takes a similar view, or I hope a more enlightened view that a digital dollar can exist side by side, well-regulated, well-functioning stablecoins. Let's face it, all the innovation has come from the private sector. The Federal Reserve has a lot to learn from stablecoin operators. And if you followed reports in the last 24 hours, which I know from my own work is true, the Fed is looking very closely to the work and, in fact, recruiting a lot of senior executives out of our stablecoin operators to learn what they've learned over their 10 years of operation. So there's a lot to learn from private innovation. You know, in the United States, when we've done big things technologically, it's almost always been a partnership between the official sector and the private sector. And I think that's the way to go as we explore digital money of the future.
Yeah, and I think there is a project, another project going on alongside all of this, right? Between the Fed, the Boston Fed, and MIT as an example on this. But can we hit pause for just 1 second? Maybe I'm the only one that needs education on this, right? But let's talk about the digital dollar or a central bank digital currency, because I think a lot of people would say, well, wait a minute, if I go and I tap my Amex card at Starbucks and instantly I've paid for, from my perspective, I've paid for something. The banks will have to settle at some later date, right? When banks transfer money, it's not like the Fed or a bank walks a bunch of cash across the street to the other bank. It's a keystroke away. I'm Venmoing for dinner with my friends, whatever the case may be. It feels like there is a digital dollar already out there. So what's the difference between that and a central bank digital currency?
So at the point of transaction, it'll feel a lot the same. You'll still use an electronic reader on a kiosk and maybe a mobile device. So it'll feel the same. But behind the scenes, it's a whole world of difference. So when you pay for something with Apple Pay, you pay something with Venmo, it feels as if you transferred value immediately and got value immediately. But in fact, that's not the case. What happens at the point of sale is actually a series of messages are going back to financial institutions. And there's a whole series of verification. Remember, I mentioned at the beginning with the token, the process of identification is to identify the token. But with these bank transfers, the process of identification is to identify you, first of all, where you bank, how much money is in your bank, and then the credit from your bank to somebody else's bank, and then to confirm that that bank received the value. There's a whole series of information leakages, who you are, where you bank, how much money is in your bank. And so the messages merely instruct a whole series of validations and information transfers behind the scenes. That transfer may seem immediate to you, but it actually is taking a lot longer time and involving a lot of people. That's why our existing system, Kevin, remember I mentioned the shortcomings of tokenized money is it's local. The shortcomings in the existing system is it's exclusive, it's expensive, and it's slow. And why is that? It's exclusive because only people like you and me who have identity can use it. If you don't have identity, you can't get a bank account. You don't have a bank account, you cannot use all those systems. Well, in a world of 8.5 billion people, over 1.5 billion do not have identity. They are excluded from the financial system. And in our own country, over 5% are unbanked and 15 to 20% are underbanked. And identity is a big reason why. It's also expensive because all of that validation that takes place, who you are, where you bank, how much money is in your bank, did your bank account credit another bank, takes time and it costs money. The breakthrough of this system is when you take your Apple Pay, when you take your mobile device to that Apple Pay reader, instead of all these messages going through, a basically money actually moves, value moves from your phone. That shop has the money immediately. He's not waiting 30 days for a credit card payment. He's got it immediately, can immediately turn around and pay a subcontractor or a distributor. So the velocity of money will increase manyfold. The immediacy of value transfer will be a boon for small and medium-sized businesses. It also removes all that need for all that information leakage because the only thing that needs to be validated was if you're paying for a $10 sandwich, whether your cell phone actually carried the right algorithm for money. They don't need to know who you are. They don't need to know where you bank. They don't need to validate that you've got enough money to cover a $10 sandwich in your bank or a $1,000 purchase of a piece of a new laptop computer. So it's a complete change in the architecture of how money moves. It's much more like sending a text message compared to the old way of going through the post office to write a letter and having the intermediary deliver it to somebody else's house. You send a text message, say it's there immediately. When you would do a money transfer with sovereign money in the future, it would be there immediately. It's a different architecture.
So that, I understand everything you just said. That also sounds incredibly attractive to those who wish to evade detection, those who wish to not be traced, make it difficult for criminal investigation of following the money. Talk about that element.
So we have that same element today in cash. And the way we've decided to handle it is, if you do an illicit transaction for under $10,000, you're going to do it. But over a certain limit, especially if you're dealing with a banking institution, we require record keeping. And that's how we address the issue with cash. With our bank system, because identity has to be established in every case, our central authorities have the ability to basically gather enormous amounts of data. And I can tell you that most of that data is irrelevant in capturing financial crime. Our current AML KYC program has an over 95% false positive rate. The amount of money it costs us to gather all this data is not nearly justified by the amount of financial crime we catch. And yet that's the state of the art. That's our system today. And I often hear a lot of my regulatory colleagues say, well, we need to preserve that system. And I say, maybe for theater we do, but not for its effectiveness. In a lot of ways, we have our TSA system. I hate to be critical, but it's a fair amount of theater for how much actual criminal activity detects. And in a lot of ways, our AML KYC system is basically the best we have under the old architecture. The fact of the matter is, if we go to a distributed ledger-based monetary system where transactions are not anonymous, they're pseudonymous, because everything is recorded on a blockchain, everything can be reverse engineered to find out who was behind it. And so rather than having a system that records identity in every case and then reports the name in case they did something wrong, we could go to a system where on a blockchain, we could have regulators be nodes on it, observing all the activities and using modern technologies of pattern recognition, artificial intelligence. We can actually detect on an activity basis where there may be reason to believe criminal activity takes place, and then go back and basically unmask the pseudonymous behavior to find out the parties involved. And while that may seem so forward-leaning in our existing architecture, it's actually what we do every day in other forms of law enforcement. Take traffic and highway safety, for example. We don't require everybody before they get on a highway to stop at a toll booth, give up their name, give their social security number, tell them where they bank and where they garage their car, and then allow them to get on the highway in case they do something wrong. No, we allow people freely to get on the freeway, and then we use pattern recognition, speeding or unsafe driving behavior to identify patterns that may indicate criminal activity or illicit conduct, and then we pull them over and stop them. We could apply the same thing in a distributed ledger monetary system rather than getting identity every sandwich you buy, which is what you do today if you use anything other than cash. We could not get identity in every case, but we can use pattern recognition, or we may say over certain thresholds of activity, as we do with cash, you need to report who you are, otherwise it's anonymous.
So I'm aware of the time, and I know I promised you I would get you out of here at the bottom of the hour. And there's two other subject areas I want to cover really quickly. But just on this final point, I don't want to open a whole Pandora's box here. But given everything you just said, would you advocate for the banning of then these so-called privacy coins, like Monero or whatever, that they make it incredibly difficult to trace or track, and it essentially thwarts the law enforcement and anti-money laundering.
Well, so I'm so glad we're coming to privacy as our final set of concepts, because I think privacy, it all comes down to privacy being the most important issue. Whether it's a non-sovereign or a sovereign, I think in our democratic system, we've got to find the right balance between privacy and law enforcement. We cannot have a system where if people feel they are engaged in something that's lawful but controversial, that information is either going to be taken by big tech to censor it, or by big government to censor it. So we can all agree that using any form of money for drug trafficking, money laundering, tax avoidance, we need an effective system to prevent that. We also can agree that if one chooses to shop at Neiman Marcus as opposed to Saks Fifth Avenue, that their choice should be their choice. And if they want to sell that information, they can be able to get some value for it. But if they want to keep it private, they can keep it private. But what about things in the middle? What about contributions to perhaps controversial causes, depending on one's point of view? Planned Parenthood or the NRA or the right to life. In certain political environments, those choices governments or big tech may want to know and may want to surveil. But in a democracy, we've got to make sure we preserve privacy for those types of choices. And we're looking across our northern border right now, where for a time it appeared that Canadian banks were not only censoring, but were stopping contributions to, political dissent. Is that the kind of thing that we either want, Jeff Bezos or Jack Dorsey, or, Elizabeth Warren or Tom Cotton to be able to surveil? I think this is, to me, ultimately where the most important thing is. I agree, privacy coins that are used in illicit conduct need a regulatory crackdown, but we need to be able to do it in a way that is subtle. We need to preserve, if we're going to have true democracy, what is freedom of religion in a capitalist system other than expressed through financial contributions to your church, to your synagogue? What is freedom of speech except expressed through financial activities by supporting causes you believe in? Our fundamental freedoms in a capitalist system depend on financial liberty. And so, and liberty means freedom from censorship, freedom from surveillance for those controversial causes. So for me, and one of the reasons I started the Digital Dollar Project is, we opened with this, because it's so important that as we're going into a new phase of money, and I believe we truly are, we need to preserve the values that got us here as a democracy, and that's financial liberty and freedom from censorship for lawful activity. And we got to find that balance and get it right. I'm confident we will, but we've got to get it right.
And so that that ledger remains what it is, but it is consistent with the principles enshrined in things like GDPR and others.
So, but GDPR is interesting because GDPR protects you from commercial exploitation of your data, but not from government surveillance. GDPR actually puts very little restrictions on government surveillance. And the Fed put out a paper just a few weeks ago on a U.S. Federal Reserve digital dollar, and they talked about protecting consumer privacy. And I responded with a statement that that's concerning, because if all it's going to do is protect our choices at Neiman Marcus or Saks Fifth Avenue, but not going to protect whether we contribute to Planned Parenthood or Right to Life, that's of concern. I think that's of concern in a democracy.
So, as we move into 2023 then and beyond, and the universe gets bigger, it becomes more accepted as a medium of exchange, as a store of value, as a unit of account, and as the central bank digital currencies come online, et cetera. The bigger it gets, the more questions that will emerge and the more complications that will emerge. People who hold digital currencies will die. They will get divorced. They will, some of the crypto exchanges will fail due to fraud, due to crime, theft, whatever the case may be. you're a lawyer with a digital practice. The consulting and financial services world out there is going to have to then address the unwinding of businesses that fail. Is this and this all of these kind of questions of who actually owns and in which jurisdiction, where are the servers, all of this kind of stuff is going to be very complicated. How is this just a giant nascent business or what?
So I think there's going to be a huge disruption. I think there's going to be some legacy financial institutions that are going to find that the new world is one that's perhaps not conducive to their traditional business model. I think there's going to be a tremendous opportunity. So let me give you one area out of my own field that I think is going to be tremendously threatened, and that is trust in the states. We didn't even get a chance to talk about how digital currency allows for programmability. Well, think about this. Right now, if I want to leave money to my children and grandchildren, I've got to rely on a whole series of people and institutions who will survive me to follow instructions I give them to give to my children. Let's say I want my grandchildren to get money when they reach the age of 30, provided they are drug-free, sober, and have a college degree. Well, I've got to rely on some trustee to validate all those things. Well, with digital money, I can simply program my money to do those things. All my grandchild's got to do is have her college send a copy of her diploma to a mobile device and breathe into it to determine she's sober, and the money goes to her wallet. Poof, there goes trust in the states, executors, there goes trust companies. It's an amazing disruptive technology that we didn't have before. We think about project finance, you rely on validators to say, well, phase one of the bridge in Malaysia has now been built, the money gets released. Well, all of that can be automated and programmed into the money. It's going to have a tremendous disruptive effect. I talked about correspondent banking. So money is going to move around. The Internet of Money can do to correspondent banking what the Internet did to the post office. Everything went to email, and so it's going to be very disruptive, a lot of legacy system. That's just going to happen, but it's going to have tremendous opportunity. The velocity of money around the globe will increase. The friction of money will decrease. But on the other hand, it's going to be very disruptive for sanctions power. We are simply not going to be able to sanction digital currency systems that are outside of the Western bank system. So it's going to, that as a means of statecraft, whatever one may think of sanctions, good or bad, they have been a feature of the global system. And maybe this is a good place to bring it home. As we're watching war unfold once again, and sanctions are the primary tool of statecraft, one of the reasons why, the flow of money between China and Russia is increasing directly, why China is developing their central bank digital currency, and they're developing it as an export product. People have to understand, China aims to be an exporter of sovereign digital currency system, CBDC technology, to countries around the world that will want to go to a central bank but won't have the technology. China will sell them basically digital currency in a box kits, so they can basically digitize their own currency. And those systems will be outside of the West banking rails. So we're going through a profound period of change ahead. And what I'm saying to clients right now is, get up to speed on this. Is more than just some new fancy novelty asset class. This is a wholesale transformation of money and finance and banking. It's going to have repercussions on many industries, even outside the banking system. I mentioned trust in the states, project finance. It's going to have ramifications for governments, for statecraft. This is a new world we're going into.
So let's use our last 2 or 3 minutes here to talk about a real world situation that you've kind of alluded to here. It's horrible in a way, but the war is presenting a test case in a way. Now, you've suggested that obviously we're still in a dollarized world and whatnot, so the sanctions power will be what it is, but that sanctions power is going to be declining over time. On the other hand, this would be an opportunity. You have to imagine that a lot of people would want to get out of the hryvnia or out of rubles, as an example. A potential destination would be digital currencies. Now, and I'm wondering if you think that you're starting to see that. But I also wonder about point of failure. You talk about point of failure. I mean, if the internet goes, or if Russia essentially shuts down the banking system or the internet in Ukraine, a Ukrainian coin holder is going to have a problem. No, I mean, unless they can get out somehow. I mean, to a certain degree, you can, I mean, we saw this during World War II. There's portable wealth that people can take across a border with them: diamonds, cash, gold, what have you. But how,
Yeah.
how does this work at a personal level in a situation like this, do you think?
For years, Bitcoin has had this sort of Janus-like feature of it somewhat trades like a tech stock. So on days when the market was in a bull run, it would trade like Tesla. But it also has a feature of a sort of a like gold. And so when there was huge printing of money, as there have been the last few years, and especially when the market would go into bear territory, Bitcoin would be still up nevertheless because it would be a store of value against an inflating dollar. And so right now, uh, Bitcoin seems to be selling off along with the rest of the market. But I expect you're going to see sort of a second wind. And this is my own personal view. You may see a second wind because you may see a whole lot of value transfer from Central European value holders into Bitcoin, into wallets held outside the country that can't be seized by a bank, but basically transferred from Central European currencies, people moving value into something like Bitcoin or other cryptos that are basically stateless. One of the, we're going after 30 years of globalization. There's no question we're going into a re-balkanization of many things around the globe. We're going into a series of poles, and money is in a sense no different. It's going to be separated from geography, from nation states. People are looking, especially when you've got war, people are going to be looking to preserve value outside of national currencies that could be vulnerable to runs on the bank in those areas and other pressures that war brings. So I think you might see a rebound. I don't think Bitcoin's going away anytime soon because of its stateless feature, its distributed feature, and its limited supply. As you know, it's limited to 21 million Bitcoins. It cannot be algorithmically changed. And so when you've got global inflation, when you've got central banks deliberately inflating their currency, that's an attractive a store of value for many of its supporters.
So we'll end this call where we began it, with Bitcoin. And I promised you I would end it at 9:30. Here we are. Obviously, it's quite clear. Those of you who were on this call with Larry Summers 2 weeks ago, there was going to be a robust debate amongst policymakers, amongst entrepreneurs and innovators, and central bankers and regulators alike. So we will have more on this subject in the months and years to come, no doubt. Hopefully, Chris, you'll rejoin us again at some point. It's been a delight talking to you. I've learned a lot. I'm a Luddite, I know, on this subject, but hopefully it was informative to those who are more sophisticated on this than I am. But thank you so much for your time. Thanks everybody for joining. I know it's a complicated day to join a call like this. Again, we'll be back tomorrow on the Russia-Ukraine situation. But until then, thanks very much, Chris, in Washington. Again, I want to remind everybody his new book is CrypotoDad, The Fight for the Future of Money. You probably now only need to read half of it because you heard half of it right here. But thanks very much for joining us and have a great day. I'm Kevin Kajiwara in New York.